Welcome to The Explainer, everyone. Today, we're dissecting a seriously massive financial milestone, F.N.B. Corporation's second quarter 2026 earnings. You know, if you follow the banking sector, you already know that the current economic landscape is anything but simple. Yet, amidst all that noise, some institutions are finding ways to not just survive, but genuinely thrive. We're going to break down exactly how F.N.B. is doing just that, translating their raw data into clear, actionable insights. Okay, let's dive right into this.
So it's the actually, scratch that, it's the multi-million-dollar question. How on earth does a regional bank manage to post record-breaking revenues when the broader economy is throwing curveballs like rate fluctuations and shifting consumer habits? I mean, it's easy to grow when money is cheap and times are simple, right? But hitting high watermarks in a complex environment, that requires a very specific playbook. Well, here's the result of that playbook. A massive $462.7 million in total revenue for Q2 2026. This isn't just a slight bump, it's a record quarter. And alongside this top-line triumph, earnings per diluted common share jumped a very impressive 16.7% year-over-year to 42 cents. For investors and market watchers, this is really the anchor point of our explainer today. Growth is happening, and it's happening at scale. Here's our roadmap for today. We'll start with record revenues in Q2 2026, then look at a decade of transformation. After that, we'll cover balancing loans and deposits, navigating risk and quality, and finally wrap up with the big picture for viewers. All right, Section 1, record revenues in Q2 2026. Let's look at the anatomy of a record quarter. To really understand that record number, we've got to reverse engineering a bit. Just look at the composition of the revenue here. Net interest income came in super strong at $365.7 million, operating on a highly stable net interest margin. But non-interest income hit $97 million. That is a notable 6.6% increase just from the previous quarter. And this brilliantly illustrates the power of a diversified business model. When a bank isn't entirely reliant on just charging interest, but also generates healthy fee and service income, it creates this powerful shock absorber against interest rate volatility. Moving on to Section 2, a decade of transformation from 2009 to 2026. You see, these Q2 results aren't just some sudden stroke of luck. They're the climax of a really disciplined strategy starting way back in 2009. Consider this stark contrast between 2009 and 2026. The efficiency ratio dropped from 62.9% all the way down to 53.7%. In banking, a lower efficiency ratio basically means it costs you less to generate a dollar of revenue. They've gotten remarkably leaner. At the exact same time, their tangible common equity to tangible assets ratio, which is a key measure of capital strength, beefed up from 5.8% to 8.9%. The crucial takeaway here is that they didn't just grow, they grew way more efficient and significantly better capitalized at the exact same time. Geographically speaking, if you look at the 2009 footprint, it was highly localized. But fast forward to 2026, and they've mapped out an aggressive yet carefully calculated expansion across 7 states. They've intentionally targeted a really smart combination of mature, stable markets to provide a solid base, paired with high-growth markets to drive their future expansion. But it wasn't just, planting physical flags on a map. This expansion was paired with some serious technological investments, specifically their award-winning e-store platform. F.N.B. completely recognized early on that the future is omnichannel. By creating a seamless digital experience across mobile, online, and in-branch touchpoints, they made sure their digital footprint was expanding just as aggressively as their physical one. Okay, Section 3, balancing loans and deposits. Let's talk about funding the engine.
Because to lend money, you've got to gather money, right? And 26% is a massive metric to understand here. Literally 26% of F.N.B.'s total deposits are non-interest-bearing. And that has stayed perfectly stable for 7 consecutive quarters. What you should absolutely take away from this is that a quarter of the bank's funding costs them absolutely nothing in interest. Zilch. In a world where every single basis point matters, having a stable, granular base of free funding is an incredible competitive advantage.
So where exactly does all that funding go? Well, it goes into a massive $35.8 billion loan portfolio. And this brilliantly illustrates their strategic balance. 41% is dedicated to consumer loans, while 59% goes to commercial loans and leases. They aren't putting all their eggs in one basket. Their commercial side is heavily focused on core middle market lending, which provides a steady, totally reliable yield. And for anyone out there maybe a little worried about the strength of that 41% consumer slice, consider their borrower profile. The bank's consumer portfolio is heavily concentrated in prime and super prime borrowers. In fact, over the last 12 months, the average origination FICO score was an incredibly strong 784. We're not talking about subprime, risky lending here. This is lending to highly creditworthy individuals, drastically lowering the risk of default.
Which naturally leads us to a pretty pivotal question. Growth in banking always invites risk, doesn't it? The faster you lend, the more you expose yourself to potential defaults, especially when the economy gets a bit choppy. So, just how exposed is F.N.B really? Let's take a look under the hood at their stress metrics.
That brings us to Section 4, Navigating Risk and Quality, the Defensive Playbook. Let's dive into the asset quality to see exactly how insulated they are. I'm just going to rapid fire these numbers because they speak volumes. Delinquencies sit at just 0.71%. Non-performing loans and real estate owned are at a minuscule 0.31%. And their annualized net charge-offs, just 0.19%. These are historically low levels. It absolutely proves that their proactive credit philosophy, lending to that 784 FICO score average we just talked about, is working wonders to protect the bank's bottom line. Now, we really have to address the elephant in the room for the banking sector right now. Commercial real estate, specifically non-owner-occupied CRE. Briefly, for those who might not know, this just means commercial real estate loans for properties not occupied by the borrower themselves. Think leased office spaces, shopping centers, or multifamily retail. It's a segment facing heavy scrutiny right now due to changing work habits. But F.N.B manages this brilliantly. In their non-owner-occupied CRE portfolio, the average loan size is just $1 million. Why this matters is granularity. They don't have massive, concentrated, bet-the-bank exposure on a single towering skyscraper. The risk is spread out over thousands of smaller, highly manageable properties. There is simply no outsized risk to any one single property. All right, moving to our final section, Section 5, the big picture for viewers. We've covered the high revenues, the omnichannel tech, and the strict risk controls. Well, all those strategies ultimately culminate in a record tangible book value of $12.24 per share for Q2 2026. This represents an absolutely impressive 9.9% year-over-year growth. Ultimately, everything we've discussed today, the efficiency, that 26% free funding, the $1 million CRE granularity, it all translates directly into building tangible shareholder value. So if we had to summarize the anatomy of F.N.B's winning framework, it really stands on three core pillars. 1, diversified revenue streams, ensuring they aren't just at the mercy of interest rates. 2, stable free funding, anchored by that sweet 26% non-interest-bearing deposit base. And 3, proactive risk granularity, ensuring that even in their highest scrutiny portfolios, the risk is spread thin and managed incredibly tightly. Which leaves us with this final thought to ponder. In an era where the headlines are so often dominated by boom and bust cycles, wild tech disruption, and general economic uncertainty, is slow, steady, highly diversified growth actually the ultimate banking superpower? Well, F.N.B Corporation's Q2 2026 earnings make a very, very compelling case that it just might be. Thanks so much for joining me for this explainer, and keep learning.